Hi everybody. So in this video we'll cover about the next topic like Basel II and Basel III guidelines and minimum requirement for banks to use IRB approach and its pros and cons. But before going into that, let us first understand what is the tier 1 and tier 2 capital of bank. As during the discussion of the Basel 1, we have mentioned that bank has to keep its minimum capital requirement as per the guidelines in the form of tier 1 and tier 2 capital. So first let's get a quick overview of what is the tier 1 and tier 2 capital of bank. So and what are these comprises of. So tier 1 capital is commonly known as the core capital of bank, and it is the highest liquid asset available with the bank to absorb its losses instantly. So if bank face any of the credit losses or any monetary losses due to operational and market risk. So this is the highest liquid capital available with the bank, which bank can use instantly to absorb its losses and keep its function uh, running as usual, so that there will not be any hindrance to the bank day-to-day operations and in the bank working. And it helps banks to maintain its resilient structure. And let's discuss what are its main comprises of. So it is first comprised of the common shareholder equity, and second it will include declared reserves such as loan loss reserves or the other cushion which is kept for future losses or for any smoothing out income variations. So another it include like non-cumulative perpetual preferred stock. So these are the highest liquid asset that bank has in the form of core capital and can be used instantly to absorb its losses. And also like declared reserve come from the post-tax retained earnings after dividend payout. Let's understand the tier 2 capital. So tier 2 capital is commonly known as supplementary capital, and it is kept in form of capital such as gains on investment asset, like another long-term debt with maturity greater than 5 years, and other undisclosed reserve like excess allowance for the losses of loans and leases. So these are a quick overview about the tier 1 and tier 2 capital. So let's start with the Basel II. Why the Basel II needed? So in earlier video we have covered like there are certain shortcomings of Basel I which are creating a regulatory arbitrage opportunity for a bank, and the main objective of Basel I was to maintain a global standard for the banking institution and make the bank less risky. But the objective of the Basel I was not fulfilled, and certain reforms in the Basel I was needed. So Basel II is introduced. So Basel II was effective from 1999 to 2006 or 7, and in Basel II there is three pillars framework was introduced. Pillar 1, bank will calculate its minimum capital requirement, and in the second internal capital assessment process or supervisory review. So in internal capital assessment process, bank ensures that it has a adequate capital to cover all its risk exposures, and in supervisory review, the supervisor will review the bank's capital and will recommend if it's found any issue in the bank risk management process to keep additional capital. So these are the two major points which is assessed in the pillar 2, and in pillar 3, as a part of market discipline, banks need to disclose its capital adequacy ratio and risk exposure across the different portfolio, so that the external rating agencies or the individual investor depositor can able to assess the health of the bank. And yeah, the second point in the Basel II is like additional risk parameter included. Like in the Basel I, only credit risk was considered, but in Basel II, operational and market risk was also considered, and different approach for measurement of credit market and operational risk was introduced. So the different approach is like for credit risk, there are two approach like a standardized and IRB approach was introduced. So in standardized approach, the banks or institution can take the RWA values as the supervisory values and accordingly calculate its capital requirement, and in the IRB approach, bank can use internal models to calculate its capital requirement, and mostly to calculate the capital requirement, banks needs RWA number, which is derived from the PD, LGD, and EAD number of our portfolio. And under IRB approach, there is two approach defined: foundation IRB and advanced IRB. In foundation IRB, PD account using the internal model, and LGD, EAD are taken from the supervisory values, and in AIRB model, bank can use internal model to estimate its PD, LGD, and EAD number and accordingly calculate the capital requirement. And for market and operational risk, like for market risk, value at risk approach was defined to calculate the RWA number, and for operational risk, like basic indicator approach, standardized approach, and advanced approach was defined under the Basel II. So as you can see in Basel II, there are major changes has been defined. First, in terms of the three pillar structure is defined, and in second, under the different risk parameter approach for capital calculation and the further RWA number calculation is defined. But Basel I was only restricted to standardized approach. So, and also the 8% minimum capital requirement is kept same in the Basel II as per Basel I, and also the one changes has been mentioned, like tier 1 capital should be more than 50% of the overall tier 1 plus tier 2 capital. These are the key updates that has been recommended in the Basel II guidelines. But post the financial crisis, there has been a certain shortcomings of Basel II was highlighted, and reforms was needed to align the Basel II guidelines as per the current market structure. So discuss the shortcoming of Basel, why Basel II could not able to achieve its objective, and bank did not able to maintain its capital requirement, and such type of crisis has happened. So let's start with the shortcomings of Basel II. So the major shortcomings of Basel II is the internal model risk issue. So the banks using internal model to assess its risk and correspondingly calculating its RW and capital requirement. And in this way, the bank is underestimating its risk exposure, and which is further underestimating the capital requirement for a bank. So this is a one risk. Another is the bank could not able to estimate any large event for which stress testing scenario needs refinement. Like if there is any severe economic crisis happen in the future, then is the bank is adequately capitalized to cover its losses. Also, bank doesn't have a good capital to asset ratio. So it was found that the bank's capital to asset ratio was very low. So that is also one of the shortcomings of Basel II. Other is market disclosure are not getting checked, and investor are not going through the disclosures to evaluate the status and raise red alert. And because of that, there is more awareness or needed around the market disclosure checking, so that the health of the bank can be assessed early, and any red alert is identified, then proper mitigation should be applied. And other than this, in the complex process, it is very difficult to identify the bank risk. So these are the second shortcomings of the Basel II, which need further refinement. And Basel III was introduced post global financial crisis in 2009, and till date it was effective. So the key changes or that was outlined in the Basel III guideline is it maintains the three pillar structure, but it has recommended for the higher tier 1 capital of the bank, so that bank is adequately capitalized, and in any severe economic crisis condition, the bank is able to fund its losses, and bank will able to maintain its resilience structure. So in the composition of the tier 1 structure, the Basel III guideline recommends that banks should maintain 6% of the minimum capital requirement in a tier 1 capital form. Like earlier it was recommended that out of 8% of minimum capital requirement, more than 50% is tier 1 and other rest is tier 2. But in the Basel III guideline, it was made clear that 6% should be in the tier 1 capital and the rest can be kept as a tier 2 capital. In addition to this, the guidelines also suggested for additional buffer like capital conservation buffer and counter cyclical buffer. So capital conservation buffer is 2.5% of the RWA, which is making the total minimum capital requirement from earlier 8% to 10.5%. And other than this, a counter cyclical buffer was introduced based on the bank's impact on the global and domestic market. So this counter cyclical buffer can be used in the bad or stressed scenario, stressed time, and it should be kept when it is healthy. So, and here in the Basel III, the capital to asset ratio, like minimum capital to asset ratio, commonly known as leverage ratio, is defined and recommended that it should be kept as a 3%. Further, recently, like Basel 3.1 was introduced, which include like finalizing the post-crisis reform and like additional changes to the Basel III guidelines were introduced in the Basel 3.1, and this is the current area of focus for the different banking or financial institution to comply with all these guidelines. So in the Basel 3.1, as banks, the as the Basel committee found that there is excessive variability in the RWA, so reduce the variability. Certain changes were defined in the Basel 3.1. First is like there is definition changes to IRB exposure classes and subclasses was recommended, and there is restriction on the IRB modeling, and there is also input and output floor was defined. So in the IRB exposure and subclasses, like classes including central government, central bank was defined. Then two classes for quasi sovereigns and others was defined, and there are three subclasses for specialized lending, financial corporate and large corporate, and other general corporate was defined. So these are on the definition of the different exposure classes for a banking institution, and then the IRB modeling. Banks cannot use IRB modeling for the central government and central bank. Bank can only use the standardized approach for calculating its the RW and the capital requirement, and also like banks cannot use AIRB modeling for the institution, financial corporate and large corporate. Only FIRB approach is recommended to use for this institution, financial corporate and large corporate. So these are on the restriction on IRB modeling, and on the input and output floor, the RWA obtained by the using internal model should not go below the 72.5% from the standardized approach. So this is the flooring of the RWA number, which is further impact the capital calculation, and it is like the guideline is suggesting that the if even if the bank is using its internal model, the final capital requirement or the coming from the RWA number, it should not go below the 72.5% from what is getting from the standardized approach. The second is on the probability of default value of a customer. So no customer is allowed to have probability of default below 0.05%, and LGD floor is recommended for secured and variable LGD floor for partially and fully secured portfolio, and also like conversion factor floored at 50% of the standardized conversion factor. So these are the certain restriction that was imposed on the different imposed on the use of the internal model to calculate its final RWA number. So this is Basel 3.1 is a current area of focus for different banking or financial institution. So let us discuss what are the minimum requirements for a bank to adopt IRB approach. First, bank must demonstrate as national supervisor that it has a rating system and it is using that rating system in its day-to-day activity to provide loan, and it has not been just designed to calculate the capital requirement. And Second is like there is consistent way of risk estimation and parameter are based on borrower and well as transaction characteristics. And there is proper corporate governance and oversight, and rating system must be approved by the board of director, and it will be periodically reviewed, and the board should recommend a particular area of improvement. And also the bank need to demonstrate like it has a independent validation of the internal risk system independently from the model development team, and there is ongoing periodic monitoring of the rating system is done to maintain the consistency and accuracy of the system. And also there should be an internal audit function which must review the rating system or rating system at least once a year, and any finding must be documented and shared with the board approved risk management committee. And the banks must needs to demonstrate its compliance with the minimum requirement and suggested by the Basel guidelines to use this IRB approach. So, and also reporting is required by what is the risk profile by grade, migration across different grade, and what is the risk parameter estimate for each grade, and also like what is the actual default rate and predicted default rate. Let us discuss what are the pros and cons of IRB approach. So IRB approach help banks to have a precise risk estimation of obligor based on the internal data of obligor, and also it's help bank in large capital savings, as the RWA number that the supervisory suggested, it is based on the industry benchmark, and maybe if bank use its internal model to assess its risk accurately, the banks can save a sufficient amount of capital which can be further deployed to enhance the bank business. So these are the major pros of the using of the IRB approach, and most of the big banks or like the global systematically important bank, they use this IRB approach to save a certain capitals to enhance its business activities. And when we discuss about the cons of the IRB approach, first, it requires a large investment to establish such a rating system and the data system, and usually it required at least 5 years of data to build internal risk models. And further, there are more discretion in the hand of bank and how they value their risk. So these are the key pointers of the cons of the IRB approach. So yeah, means that's all for this video. And in this appendix, I have just added sovereign and corporate portfolio. What are the different risk-weighted asset as per the Basel guidelines? Yeah, thank you all.